By definition, a bond is simply a loan given to the issuer or the borrower by a bondholder, also known as lender, whereby few terms are predetermined, like terms of interest payment, redemption dates, etc. So essentially, when you are buying a bond, you are essentially lending money to an entity known as an issuer. This legal document which registers this loan is called as a bond. A bond or debenture used as synonyms are basically terminologies in a differentiate way. When a government issues a debt instrument, it is known as a bond. And when corporates issues debt instruments, they are known as debentures. Now, there are few characteristics which we need to keep in mind when reading or understanding about the bond. The first and the foremost is the issuer of the bond, or the company who is raising the capital. For an example, ABC Limited, who wants to borrow money, who wants to have some kind of borrowing from the market, they issue bond. They become the issuer or the borrower. The second most important factor or a characteristic of a bond is the face value of a bond, which is a minimum denomination of a bond. So interest rates or the coupon rates is the interest income or the interest which the issuer of the bond is agreeing to pay to the investor at regular intervals, or periodicity is predetermined. This is known as an interest payment frequency. It can be monthly, quarterly, semi-annual, or annual. One more important parameter to understand the characteristic or a characteristic of a bond is a rating agency, rating which the credit rating agency has given it to him. A AAA or a AA, this is a parameter to evaluate the credit worthiness of the bond. Maturity date or a redemption date means on the expiry date, the date the bond matures and the principal money comes back in the hands of an investor. A bondholder, or the last and the least, the most important characteristic, bondholder, yani the person who is subscribing to this bond or who is buying this bond or acts as an investor in this bond. Broadly, the bond market in India is divided on the basis of the issuer of the bonds, the government securities or the government bonds or the corporate bonds. What do you mean by government securities? As the name suggests, the issuers are state government and central government. When state government borrowing or issuing debt instruments for their borrowing requirements, they are known as state development loans or SDLs. When central government borrowing or issuing debt instruments, they are known as government securities. And when they are borrowing for less than 1 year, less than 365 days, they are the instruments or the debt instruments are known as T-bills or treasury bills. As the name suggests, corporate bonds, when corporates are borrowing money. Now, corporates can also be of two types: public sector corporates or the private sector corporates. Public sectors like PFC, REC, NHAI, where the majority stakeholder is either a state government or a central government. And private sectors, where the issuer, where the entities holding this in company are basically the private entities, like an L&T or a Tata or Mahindra and Mahindra. When they issue bonds, they are known as debentures, essentially in the format of non-convertible debentures and market-linked debentures. And anything lower in terms of tenure and less than 365 days, they are known as commercial papers or certificates of deposits. When bank issuing instruments, debt instruments, which are less than 1 year, they are known as certificate of deposits. And when corporates issuing debt instruments, which are less than 1 year, they are known as commercial papers. One of the important parameters in evaluating the bond is a credit rating. So what is the role or a significance of a credit rating agency? मतलब क्रेडिट रेटिंग एजेंसी का काम क्या होता है और हमको उससे क्या फायदा मिलता है? This is most important when you are reading or understanding in terms of investments into a bond. So job of a credit rating agency or a role of a credit rating agency is to evaluate the credit worthiness of the underlying debt instrument or the issuer. How do they do it? They do the due diligence of the underlying entity, underlying security. They evaluate the financial performance. They see what is the track record of the issuer and how far they are capable of servicing their financial obligations when it comes to repayment of principal as well as interest to the investors. Depending upon their evaluating criteria, they give grades to those underlying instruments. and these are known as credit ratings. AAA means the highest degree of safety or the lowest degree of credit risk on these instruments. And as we go down the ladder, the degree of safety keeps on reducing and a degree of credit risk keeps on increasing. So AAA, AA plus, and AA minus, and henceforth. Till triple B, we say these are investment grade instruments. Anything below triple B, we have C and D as well as ratings. These are considered as non-investment grade securities. Credit rating agencies, they have to take license from SEBI. So SEBI acts as one of the prominent regulator when it comes to credit rating agencies as well. CRISIL, ICRA, India Ratings, CARE are some of the rating agencies which are available in the market, and most of the debt securities, almost all debt securities, are rated by these entities. Mode of issuing the bonds in our country, how the bonds are issued in the market, and how the investors can apply for it.
Sure. So in the first place, bonds can be issued in two formats. One is the public issue, which is a fairly regulated form of issuing bonds, where SEBI ensures that best of the disclosures are made in the offer document for investors for taking an informed decision. And it is an issue of debt securities to public at large. So you and me as a retail investor or a HNI investor, we can subscribe these debt securities known as bonds. And since it is targeted towards the lowest spectrum of investors, the minimum ticket size is generally 10,000 rupees. So the face value attributed to a bond is 1,000 rupees, and minimum investment generally is 10,000 rupees. And since it is targeted to public at large, the participation in terms of investments comes in from retail investors, corporates, HNIs, institutions. For that matter, any entity who's entitled to invest in bonds can apply for the issue. The other format is private placement, which is more of institutionalized framework, and hence not very much in regulatory domain of the regulators. Here, basically, the participants are issuers, which are qualified issuers, and then there are investors who are institutions, corporates, or HNIs. And since this name, as it is, this suggests that it is a private arrangement between an issuer and investors, and therefore the ticket sizes are higher. They are generally 10 lakh rupees or above. So this is a sample term sheet. When we attribute features to a bond, there is a term sheet which defines the basic parameters of a bond. For example, the issuer, as we discussed last, is the most important entity who is basically issuing the bonds. So for example, ABC Finance Limited is the issuer. So investors are taking a position, first of all, in the issuer, that how comfortable they are and how they view this entity to be servicing the debt obligations in time. There is an aggregate issue size attached, which we have assumed, say, 100 crores. So aggregate amount of all debt securities outstanding in a particular issue would be 100 crores. And mode of issuance, as we discussed, could be private placement or public issue. Type of instrument is again very significant because it characterizes the entire feature of the bonds. For example, senior, secured, redeemable, rated, listed, taxable, non-convertible debentures. Whichever form they are, basically these are non-convertible debentures, which means they will not get converted into equity or any like instrument during the life course of the instrument. Then there is a rating assigned, as we discussed just now. The rating agencies like CRISIL, ICRA, CARE, India Ratings, they assign the credit ratings to the instrument, which is basically a rating assigned to the particular issuer and the specific instrument that they have issued. So rating, we have assumed, say it is AA plus. Issue price or face value is again very important, because if the face value of a bond is 1 lakh rupees, it can trade in denominations of rupees 1 lakh. So therefore, face value is important. Coupon is nothing but rate of interest that the bond fetches, which is assumed at, say, 8%. And coupon payment frequency, as we discussed, could be monthly, annually, semi-annually, quarterly. And in some cases, it can be even be payable right at the maturity, which are cumulative bonds or zero coupon bonds. There is a tenor attached to every bond as to when the bond will mature in the hands of investors. So which we assumed could be 2 years, 24 months. There is a security which is again very important. So generally bonds are secured against fixed assets or receivables of the borrowing entity. And there's adequate security cover of 1 to 1.5 times of the aggregate principal amount and the interest amount which is payable on the bond. There is something called call and put option. So call option is an option with the issuer to redeem the bonds prior to its maturity, and put option is an option with the investor to claim redemption of the bond prior to maturity.
Now let's understand what are the types of bonds which are available for investors to invest in. Now types of bonds can also be structured in various formats. एक तो वो condition की bond का structure, what are the covenants on the basis of which the bond issuance or a debt instrument has been structured, and on the basis of the issuers who are issuing the bond. So let's try and first evaluate the basic types of bonds which are available in the market on the basis of the covenants or structures. So the first category, or a very regular or a general category, is a fixed coupon bond. What it means, as the name suggests, fixed coupon means the coupon rate or the interest rate for this bond is fixed till the maturity of the bond. So whatever the life cycle of a bond is, a 3-year bond or a 5-year or a 10-year bond, for the entire period of the bond, the coupon rate will remain fixed. For example, अगर 8% coupon है, so every year, if it's a regular yearly interest payment structure, every year I will get 8% as an income on this investment in bond. The second category on the basis of the structure can be a floating rate bond. Again, as the name suggests, very simple to understand. Floating rate means interest rates can fluctuate. But how will they fluctuate? They are linked to some reference rate or a benchmark. For an example, like a GSEC or an MCLR or a T-bill, some underlying benchmark within which they are linked, and there a spread has been created. कि अगर GSEC 25 basis point move करेगा, तो मेरा coupon rate भी 25 basis point move करेगा. Just for an example, it can be a 40 basis spread from the underlying, it can be a 80 basis spread from the underlying. But the idea is to make you understand a floating rate bond is linked to an underlying benchmark, and as according to the benchmark moves, the interest rate also moves, and that is the income in the hands of an investor. The third category is a zero coupon bond. A bond which doesn't have a coupon. It doesn't mean वो interest pay नहीं करेगा. It means that bonds are generally issued at a discounted value and are redeemed at the matured at the face value. For example, a bond which is a 1,000 rupee face value will be issued at, say, 900 rupees. So an investor initially makes a payment of 900 rupees, and on the maturity of the bond in a cumulative format, 1,000 rupee will be given in the hands of an investor. So that 100 rupee becomes the income of the bond investor, and you can calculate, depending upon the tenure of the bond, what is the yield for that particular instrument. So fixed coupon, floating coupon, and a zero coupon. Now let's understand a different structure which is known as a tax-free bond. Again, as the name suggests, tax-free means the interest income on investments on these bonds are tax exempted. These bonds are issued by government entities, the corporates controlled the PSUs, where the promoter is a government of India. So PFC, IRFC, NHAI, they are the issuers of these tax-free bond instruments. Interest income or the interest earned on these bonds is completely tax exempted, and there is no tax liability when you invest into tax-free bonds. Essentially, very high in demand in terms of HNI investors or anybody who's in the higher tax bracket. The fifth category, and reasonably a new category in the market but highly in demand, are the market-linked debentures, or again bonds or debentures, market-linked debentures issued by corporates, where the returns are not fixed but are linked to the performance of an underlying index. So they are not regular interest payment structures like a floating rate bond which is linked to an underlying, but in floating rate the coupon rates were defined Here, the coupon rates are not defined. They are linked to the performance of an underlying index. And as and when the index performs at maturity in a cumulative format, the returns are given in the hands of investors. So they are generally known as PPMLD, or principal protected market linked debentures, where a principal is protected, but returns on the bond or the coupon is defined on the performance or the movement of an underlying benchmark. Generally, GSEC becomes an underlying benchmark, or an index, Nifty index becomes an underlying benchmark for market linked debentures. Last but not the least, on the structure category are the capital gain bonds or 54 EC bonds, very prominently used by investors, where a capital gain earned by the sale of immovable properties, immovable assets, are parked in these bonds, and that interest, in though interest income is taxable, the entire maturity amount becomes taxable in the hands of an investor in the format of capital gains which you have earned. So essentially, if you have earned a 50 lakh rupees of capital gain while selling of your immovable property or immovable asset, you can invest that 50 lakh rupees into these bonds, and at the maturity of this bond, the entire amount is your capital gain is tax exempted under section 54 EC. Types of bond on the basis of the issuer. Like we have studied, on the basis of the structure of the bonds can also be divided on the type, on the way the issuing entity is. A central government issuing bonds to fund their requirements, which can be of social nature, social welfare, healthcare services, defense, infrastructure building. Central government issuing bonds, they are known as GSEC, or government securities. Central government say, obviously you don't have to worry about credit risk. They are considered as almost risk-free. Highest degree of safety, also known as sobering bonds. One thing is to keep in mind, when central government issuing bonds, GSEC interest payment frequency is semi-annual. So twice in a year, every 6 months, they pay interest, or the interest payment frequency, call it as a semi-annual. Same way, then when state government issuing bonds, they are known as state development loans. They issue debt instruments again for their state development requirements. They borrow money in a similar format like central government. State government bonds are also considered risk-free. Again, similar to GSEC, their interest payment frequency remains semi-annual, or every 6 months they make interest payments. The third category is a PSU bond. Very simple to understand. Issuing entity is a state or a central government owned entity, public sector enterprises. When issuing bonds, they are known as PSU bonds. So if IRFC is coming out with a bond, it is a PSU bond. If NHAI, National Highway Authority of India, is issuing bonds, they are PSU bonds. If UP Power is issuing bond, it is a corporate bond which is controlled by, so I'm going to come back to the corporate bonds. Corporate bond issued, which is under the control of state government. So PSU bonds are the bonds which are issued by the entities which are controlled by state or central government. The next category is the corporate bonds, yani ki private companies which are issuing debt securities or debt instruments. For example, Mahindra and Mahindra issuing bonds. For example, L&T is coming out and issuing bonds. A Tata entity coming out and issuing bonds. These are debentures, non-convertible debentures. They are known as corporate bonds. Corporate bonds can be subdivided, or can be largely the biggest category of corporate issuers in Indian context are the NBFCs, or non-banking financial services, which issue bonds. Say housing finance companies, gold finance companies issuing bonds, they are known as NBFC. Two-wheeler finance company, commercial vehicle finance company issuing bonds, they are known as NBFC bonds. And one of the largest category of issuers in the market are bank bonds. Bank issue bonds on a regular intervals to fund their requirements. They are known as bank bonds, and bank bonds can be subdivided into multiple categories.
In the first place, we need to understand as to why banks raise bonds, because banks, as we understand, are largely funded by our deposits. We keep our savings in form of current account deposits, or saving bank account deposits, or term deposits. but essentially they are short-term deposits of up to 3 years. So banks also do infrastructure long-term funding. For example, they lend for 10 years, 7 years in long-term buckets. So they need a commensurate liability which that they need to pay over long term. So therefore, they raise three categories of bonds. One is a senior bond, the other is a tier 2 bond, and the third is AT1 bonds. So essentially, the purpose of raising senior bonds is to fund infrastructure, while tier 2 bond is issued for raising tier 2 capital, and AT1 bonds, as the name suggests, is raised for meeting additional tier 1 capital requirements of the bank. So there is a few things common in all the three bank bonds. One is that they are all unsecured, just like fixed deposits of the banks. And there is no put option with the investors, in the sense if the bond is maturing after 10 years, during the course of 10 years, the investors or the bondholders can trade in the secondary market, but they cannot claim repayment during the life cycle of the bond. So there is a maturity attached to these instruments. Normally, senior bonds are issued for a minimum maturity of 7 years. Tier 2 bonds are generally issued for 10 years, and AT1 bonds are perpetual in nature. There is a principal loss absorption clause, which we should understand is not there in senior bonds, but there is a component of loss absorption clause in bank tier 2 and AT1 bonds, that there is a stage called point of non-viability. So if we basically, if the RBI so feels that a particular bank is heading to a situation where if the bonds are not written off, it will land into a point of non-viability, or there is a capital infusion required by the government or any regulator to keep the bank as a going concern. So under such eventualities, the bonds, principal amount of these bonds, which is essentially tier 2 bonds and AT1 bonds, can be written off. So bonds can be classified mainly as secured bonds or unsecured bonds. So secured bonds, as the name itself suggests, are secured by some collateral, which could be in form of charge over some fixed assets, immovable properties of the issuer, or if it is an NBFC, charge over the receivables of that particular financial entity who is issuing bonds. So secured bonds get classified into further two categories. One is senior bond, where the charge is in form of first or pari passu charge. So therefore, all the bondholders who hold securities of a particular issuing entity, their claims are at par with all pari passu amongst themselves. While there is a second category called subservient charge, where the bondholders are assigned a residual charge over the assets of the issuer. And in unsecured bond, we have one senior unsecured bond, which is not backed by collateral, but still it is senior amongst the category of bondholders. Then there is a subordinated bond, which is right at the down of the ladder, which is the claims of bondholders in subordinate category are subordinated to all the liabilities of the issuer. And as we discussed about seniority of bank bonds, the senior bonds are at par with depositors. Tier 2 bonds are subordinated to depositors and senior bonds. AT1 bonds, the claims of AT1 bondholders are subordinated to tier 2 bonds. And at the last ladder, basically there is equity, where the claims of equity shareholders are subordinated to all liabilities.